So what we're here to talk about tonight, though, is something a little less recreational, which is alternative financing. So what the bank has done, after working with the local franchisee, John Krause of Liquid Capital, who will introduce himself in a minute here, the bank is actually partnering with Liquid Capital on a more formal basis. And the reason we're doing that is the foundation of this bank, the mission of this bank, has been to help start-up businesses that are in distress, and to have a wider credit box than most of our peers or competitors, so that we can help as many small businesses as possible. But with all the regulatory pressure that has come under banks since the bank was founded 20 years ago, actually, we've been in business now, it's been harder and harder to do some of that out-of-the-box lending, particularly when it comes to working capital financing. So you're all familiar with the online, I call them the loan sharks, the fintech lenders. So we're trying to offer alternatives to that very expensive, high-interest financing. And we partnered with Liquid Capital to do that, because they've got some great programs that are outside of the normal realm of bank financing for working capital. And it's going to allow us to kind of expand, get back to our core mission, which try to help as many small businesses as we can. And some of those businesses are just not going to be bankable right out of the gate. But the idea is we want to develop a relationship with them on the banking side, have Liquid Capital use some of its programs on the financing side, and then graduate them into a place where we can help them either with an SBA loan or with conventional financing. And in some of these circumstances, we can actually work in conjunction with Liquid Capital on the same business at the same time, because they're more transactionally oriented, where we can provide longer-term financing. So, why Liquid Capital? Many of you may know, at Enterprise, we have a very unique type of business model. Our RM team, and they're mostly in the back, some of them are seated here, there's 7 of them. Our RM team doesn't have a salary or commission structure. They get a percentage of the profitability of their loan and deposit portfolio. So they only get paid as long as 1, their clients are viable, i.e. making payments, 2, happy with the service they're getting. Because if one of our clients refinances with one of our competitors, that income stream to that particular lender stops. And in exchange for that type of annuity-based income stream, they also take a personal stake for a percentage of any loss that the bank takes. So they have true skin in the game. So what really intrigued us about working with Liquid Capital is they have a very, very similar business model, which they'll explain to you. But basically, the local franchisees for Liquid Capital, in many of their programs, are using their own money to fund these businesses. So they're not lenders for another organization. They use the support of the organization, but they're using their own money. That's the ultimate skin in the game. So it's a very similar type culture. It's a very similar approach from a service perspective, because there's boots on the ground here locally with Liquid Capital, just like we have our RM team here at the bank. So we think it's a very good mesh of philosophies, and should be able to greatly expand the breadth of the types of businesses that we can deal with. So with that in mind, I'm going to let John and Tom introduce themselves and talk a little bit about who they are.
Local guy.
Thanks, Dave. Hello, everybody. My name's John Krause. I live here in Pittsburgh. I'm in the Mars area. I'm the local Liquid Capital franchisee. Formerly a Heinz guy for many years, but now in the alternative financing business. So nice to know some of the folks in the room, and thank you for coming out tonight.
My name's Tom Stamborski. I'm based out of Chicago, and I'm the program manager for our Bank Alliance program. So working with our offices in various parts of the country, developing these type of strategic relationships. I'm also the sales manager for the company as well. And I'm just delighted to be here tonight. It's a great turnout. Really appreciate it.
So Tom, you want to give them a little history?
All right. I'm going to walk around.
Actually, I'll work the clicker for you if you want.
Oh, I'm good.
Okay.
Unless I'm technically challenged.
There you go.
So a little background on Liquid Capital. We're just shy of 20 years in the alternative financing space, if you will. The company started in Toronto. We still have a very significant presence in Toronto. We also have another satellite office in Montreal. And we have a very significant presence in our underwriting unit, which is in Irving, Texas, which is the Dallas area. We have 60 independently owned offices, just like John's franchise, throughout North America, quite a bit in Canada, and quite a few offices in the United States as well, all with similar types of individuals, professionals that have become franchises with us. They're independent business owners. They all have committed capital in these transactions. And many of them work with financial institutions, with commercial lenders. And we've done that for a number of years, as a matter of fact. We decided to formalize the program, if you will, or the relationship, by developing the Bank Alliance program to become a true working partner with our bank relationships. As Dave pointed out, we do have a very unique business model. And that's why I think our cultures have really become very well suited to working together, high service oriented, working very closely with our clients to really understand what their needs are, what kind of strategic solutions that we can provide to them, and be able to work side by side with the bank to come up with the most optimal solutions for their particular situation. So one of the things that we discussed is we were discussing the relationship, and rightfully so, they were very concerned. Is this a good match? Can we work together? Is this going to be kind of a harmonious type of relationship? And we, through some discussions, really decided it's a very, very good fit. And I can say that I've worked with a number of banks over the years. This is a very unique business model, and ours, because of the structure of actual ownership, if you will, is also unique. So we find it to be very, very compatible. We have a number of financing programs which we're going to discuss this evening. We're here to work with small and medium-sized businesses, typically B2B businesses, although in certain circumstances we can work with B2C companies, but B2B is our real core business, if you will. And again, very consultative. We offer solutions in alternative finance. The bank offers solutions with traditional financing. That's a means to an end. It's really the relationship that counts. It's really the understanding of their situation. What are they trying to accomplish? What are they facing? What are their goals? What are their objectives? And what is the best overall solution employing the products that we respectively offer to those companies? Again, we have worked with financial institutions for really the 20 years that we've been in business. A lot of those have been kind of one-on-one kind of relationships, which have been very, very productive. But we decided as a company that we could do more. We can take these relationships and then really formalize that relationship into a strategic partnership where we work collaboratively on an ongoing basis to develop these strategies for the various types of businesses that we work with. And we'll talk about the kinds of businesses we work with and some of the solutions that we provide. And just to give you an idea of our capacity and what we've done, we're somewhere in the north, as of today's date, of $3 billion in funded transactions, and we will probably close out this year somewhere north of $700 million in funded transactions across all of our offices. There we go.
So what I wanted to do, and again, I want to be sure we spend enough time introducing the liquid capital programs, but what I wanted to do is a quick review. And you all know Enterprise Bank loves real estate. So we work with a lot of you with commercial real estate, conventional mortgages, SBA 504, those types of things. But the working capital programs, I wanted to just review with you real quickly, because we do a couple of unique things here on our own that'll even be expanded further with liquid capital. So permanent working capital, that's your typically a lot of that's done under the SBA program, but we can do it conventionally if we have fixed assets as collateral, or if a business is very well established with a solid cash flow. We'll also do revolving lines of credit if it's either secured by a fixed asset, or again, a well-established business with strong historical cash flow. We'll do those without any strings attached, so to speak, at the discretion of the customer to borrow and repay. that a lot of what we do on the short-term working capital side are formula-based lines of credit. And I hope I'm not too remedial for a lot of you in the room, but basically what a formula-based or borrowing-based driven line of credit is customers allowed to advance a certain percentage of funds on their line of credit based on how much they have outstanding in current assets. Mostly receivables, but some cases a combination of receivables and inventory. And where we're a little bit different, when you get into true asset-based lending that a lot of the banks do, they require on a daily basis that you repay your loan, or they sweep the funds to pay back the loan and you borrow and repay on a daily basis. Well, we give a little more flexibility to the business owner in most of our formula-based lines of credit, where we leave it to the discretion and the discipline of the business owner to maintain trust in terms of always having enough receivables and or inventory, depending on what the formula is, outstanding to support the line of credit. So on those cases, which most of what we do, you give us a monthly borrowing base, and you have to maintain the discipline to not have any more outstanding than what's supported by that certain percentage of receivables and inventory. And so that's a little bit different than the way traditional asset-based lender, which Liquid Capital provides, and we'll talk about shortly. And we have the ability to do those on both a conventional and an SBA guaranteed basis. Sometimes we'll flip, and I'll talk about the SBA working capital capitalized program in a second, but in a lot of cases, it depends on the advance rate that the client needs against the receivables or the inventory. It depends on the quality of their AR and their customers, whether we go conventional or with an SBA guarantee. But that's a lot of what we do with our conventional. Now, a lot of the specialty lending that we do that a lot of our competitors don't are under the SBA program. So very quickly, just wanted to review with all of you a couple of unique things about how we handle SBA lending here at the bank. First of all, we're a preferred lender. So what that means is the SBA delegates the credit decision on a transaction-by-transaction basis to us. So they don't look at the credit worthiness or the cash flow or the collateral for a particular loan. They delegate that decision to the bank. They monitor us on a portfolio-wide basis through our performance metrics with the SBA through on-site audits or off-site file reviews that they do periodically. But what it does is it allows you to take that second guess, that question as to whether SBA will approve a deal out of the equation. Because if the bank approves it from a credit standpoint, we have the SBA approval from a credit standpoint. All we need to do these days is an online eligibility check for some basic eligibility criteria, like have you paid your taxes to the government, U.S. citizenship or permanent residency, no criminal convictions, those types of things. The one other thing that's very unique about us in the marketplace with regard to SBA lending, and you'll see the SBA numbers that come out regularly, you'll see a lot of names of institutions on there that you don't even know who they are because they're not based here in Pittsburgh. There's a whole group of national SBA lenders out there that use the program and sell their guarantees on the secondary market. Well, when you sell your guarantees in the secondary market, what generates the most premium are pure variable rate loans. So a lot of our competitors in the SBA lending realm are pure variable rate lenders. And that was all well and good for since the recession. Well, interest rates are moving up now, and it's getting to be dangerous for small business to get into variable rate structures. So we're one of the few banks that does not sell loans in the secondary market. So we'll typically offer, for term financing, we'll typically offer on non-real estate backed, that 3-year fixed, or 3-year adjustable to give them at least some interest rate stability for the first 3 years. And if it's real estate backed, we'll go out to 5 years in most cases on a fix or on a lock. The other important thing about not selling is when a bank sells a loan on the secondary market, they lose all flexibility with the customer to make any adjustments in that loan. So a lot of what we do is higher risk lending. Startups, turnarounds, businesses that are growing, they're going to need adjustments. They're going to need deferments. Maybe they're in a cyclical industry. Maybe they're seasonal. When a loan's sold, you don't have that flexibility. So we made a conscious decision, Chuck, 15 years ago, to quit selling SBA loans so that we don't lose flexibility with our clients. So a couple of niche programs. Oh, let me talk about this. So just give you the lay of the land real quick on SBA. Every year SBA comes out with a new fee structure. in terms of what they charge with regard to their guarantee fee, and then what they charge the lender as a servicing fee, which translates directly into what the customer pays in an interest rate. So these are the standard fees for this fiscal year that started on October 1. You can see it goes anywhere from 2% of the guaranteed portion for smaller loans up to 3.5% or 3.75% on the larger loans. Most of the time, those fees are rolled into the financing. They're not out of pocket. They're just included in the loan amount, so the customer basically amortizes the fee. The big thing, and for a lot of the niche programs for working capital, short-term working capital that I'll show you in a second, the nice thing about them is if you do them from beginning to end within a 1-year period, and most of the transactional related loans are that way, the guarantee fee is only 1/4 of 1%. So it's actually very inexpensive from an SBA perspective to do short-term transactional loans. The big word of the day in SBA this year is rural. That's the political focus right now within the administration, within the SBA. So if you're a rurally located business, you get some fee relief. Makes it easier or more profitable for the lenders because on the small rural loans, we don't have to pay a servicing fee to SBA, so we don't have to translate that into a higher interest rate for the client. And on the upfront guarantee fee, those have been reduced significantly for rurally located business and hub zone located businesses. And hub zone is a federal designation for historically underutilized business zone. So, we can run addresses and business locations, through the SBA database to see if they fall under one of those and qualify for fee relief. SBA's continue to really focus on veteran lending. So for veterans, there's no guarantee fees for veterans loans under the Express program up to $350. So here's some of the niche stuff I wanted to talk about. And these are fact sheets, so I'm not going to read these verbatim. But I just want to give you a little flavor for some of the niche SBA programs that we have that we utilize that a lot of our competitors don't because they are specialized. So the first is the SBA working capital line of credit, which is very similar to what I talked about a few minutes ago, where you use a borrowing base, and the borrower has to stay within a formula of a certain percentage of receivables and inventory. We can get an SBA guarantee doing that same type of lending when we need it. All SBA requires is a first lien on the current assets, receivables, and inventory that we're financing, and then the normal guarantee requirements. So this is very similar to what we do already. So there's not much more to it to add an SBA guarantee than what our bank does already with borrowing-based lines of credit. But there are a couple of really unique programs. There's a seasonal line of credit program. That's a niche program where we can finance with an SBA guarantee the direct costs for seasonal increases in inventory, receivables, labor costs. So if you have John and I met with a maple syrup company 6 months ago. Their entire cash outlay is done within about a 3-month period as they collect, boil, and make maple syrup out of sap. And they need a ton of working capital to get all that in-house. Then they sell it during the holiday season to large retailers who sell them in specialty gift packs, and they get paid within a 60-day period. So that's the perfect scenario for a seasonal line of credit. Any business that has a seasonal component, we can finance the direct cost for them to build up their inventory needs or fund their receivables on a seasonal basis. They just have to clean it up once that season's over. And some of these businesses can have more than one season within a calendar year. So the one specific requirement with this program, though, is you have to be in business for 1 year because we have to be able to evidence or see the seasonal fluctuations in receivables and inventory to do the program, to provide the financing. Probably the most popular niche program that we use that I don't think there may be 1 or 2 other SBA lenders locally that use it is the SBA contract financing program. And this is has a lot of applicability in a lot of different scenarios. So how many of you have dealt with business owners that get the large order or the large contract but they don't have the receivables outstanding to support an advance on their line of credit to fund that job. So what this is pre-receivables financing. So if they have a binding contractor purchase order with an SBA guarantee, the bank can finance up to 100% of their direct costs to complete that job or fill that purchase order before they even bill the client, as long as they have a binding contract. They take their material, their labor costs, whatever goes into that product or service, with our financing, bill the customer pays, we pay back the loan either through a lockbox or in some cases just with directing the funds to their own deposit account here at the bank. We pay back the loan, they get their margin. It allows businesses to either get that large job that is an anomaly for them that they can't fund with their normal working capital or their normal line of credit. It works well for contracts that have extended repayment terms because they only have to pay interest only with us until they get paid. The underwriting focus for this program is really about performance capacity. So we look at, do they appear to have the ability to perform the particular job or purchase order? Do they have that track record? Is it a quality pay from a client perspective that they're working with? But we can take a lot of cash flow pressure off of the business by financing either a single transaction, or we, in some cases, can put together what we call a contract line of credit, where we approve them up to a certain credit limit, and they can use this type of upfront contract financing on an ongoing basis for multiple jobs up to that credit limit. Great program. Liquid Capital has something a little bit similar. We'll talk about when theirs versus this might work the best. So these are fact sheets that I gave you in your handouts. I didn't want to go through them line by line because I wanted to make sure that we focused on what these guys have to offer tonight.
Okay, thanks, Dave. Tom and I are going to talk about 4 different products or services tonight, just to give you a little overview of some of the alternative financing tools that we can provide. So the first one is flexible invoice financing, which is known as factoring. So we have a client that needs funds for payroll operations. They had a adverse tax decision go against them last year. Something happened that caused a shortfall in the business for cash. They can't get bank financing. They just don't have the financial wherewithal to do that. Maybe they were with a bank, but the bank's kind of turning them away. Whatever it is, they just can't get the financing. But they do have high-quality accounts. They're not getting paid for 30, 45, 60 days, sometimes longer than that. What we can do with this program is we can come in, we can purchase those accounts receivables for them, typically get them 80 to 85% of the face amount of receivables in their hands within 2-3 days of the time we get the documentation done. We hold back 15 to 20% as a security reserve. Then we jointly notify their client that they are financing with us, so the client knows that they have to pay us going forward. Under the UCC, they're required to do that. When we collect on those invoices in 60 days, we turn over that reserve that we have held back, that 10 to 15% back to the client, minus any accrued fees. The clients typically continue to sell us their accounts receivable. I have a client that sells me receivables every Monday afternoon. We fund him, he's got money in the bank on Wednesday, makes payroll, pays his operating expenses. I've been doing that for a year. We couldn't get financing when we started a year ago because he was a startup. But we had great clients and a good growing business. So I may do that for another 6 months, another 12 months, another 2 years, whatever he needs. But at some point, he will undoubtedly transition to a bank to get better rates. That's just kind of the way the business goes. So we're typically a bridge to a better rate for our clients. We get them money when they can't, when they don't have the money, to get their business growing. And it really provides maximum flexibility because liquid capital doesn't require any long-term contracts. A lot of alternative finance companies require 1 or 2 year contracts. The client's kind of hooked in to finance. We have a 30-day contract, so virtually really no contract. The clients can factor all of their receivables, or they can, they may say, hey, John, I have 10 customers, 7 of them pay me in 15 days, but 3 of them pay me in 45 days. I just want to factor those 3 clients. Fine. They might want to hold on to the receivables for 20, 30, 45 days before they sell them to me, and then I'm only financing for 30 days. That's fine. So there's maximum flexibility for the clients to do what they need to grow their business. We're going to go over these relatively quickly, but then we're going to talk about a few cases. The second service works very well with a bank. So
You want me to run it for you?
since it's my last one, it's a purchase finance program. In this situation, typically clients have some bank financing already, but they need more funds. The bank just can't give them enough funds to satisfy their growing business. The client's financially strong enough to allow us to get credit insurance on the client. That's our security. We don't have to take it for security interest. Therefore, we don't disrupt any of the bank security positions. That's what makes this a good program with a bank partner. Let's say that the client's materials vendors do not offer any easy payment terms. Typically, they got to pay them right up front for the materials or very quickly, and the client's short on cash. They're turning away customers because they can't fund the raw materials or the work in process to complete the project. What we do is we purchase the raw materials for the client from their vendor. We take title, we buy the raw materials, we turn around the same day, we sell them to our client. The raw materials are typically shipped just like normal right to the client. So now the client has got the raw materials, they can monetize those, sell the products, pay us back in 30, 60, sometimes a little bit longer than that. So it eliminates the need for them to pay for those raw materials up front, gives them a little breathing room to build the products, sell it, and pay us back. As I said, no first security interest required, so it's a really nice program working with the bank. I don't know anybody else that does this. It's sometimes hard for clients to finance working process through the bank, and so this is a nice kind of unique program for the clients. I think Tom's going to take the next two services.
Let's see if I can do this. Okay. Thanks, John. All right. Asset-based lending. So Dave alluded to asset-based lending as a financing strategy where we're using actual hard assets of the company to collateralize the loan. Our view of this, or our version of this, is a little bit more of the traditional ABL, they call it ABL lines, which really encompasses receivables, inventory, equipment, and real estate. Those are the four types of collateral that are used to secure, if you will, an asset-based loan. Typically, we would give them a certain percentage of value for those various types of collateral, create a borrowing base, and then they can borrow that on an ongoing basis. You know, they're borrowing, they're replacing, it's a revolving line, if you will, which is kind of the standard configuration for ABL. I already covered that point. ABL is kind of a transitional strategy. We talked about this a little bit earlier. We have worked with clients where they're with a bank, and that bank either doesn't offer ABL, or maybe the size of the transaction is too small for them. They may be in a situation where there may be something with the relationship and things aren't working out, and they're deciding to leave the bank, if you will, and ultimately transition to another bank. So ABL is a strategy where they may not be able to have conventional financing with this bank. Their current bank can't help them. We can work with that company using the ABL strategy and then ultimately transition them into another bank, i.e. Enterprise Bank. So we're kind of a stepping stone, if you will, using that strategy. In some instances, we may have a situation where we look at a prospective client, and because of a certain configuration, the collateral base, or whatever the case may be, our particular version of the ABL is more conducive to that type of situation. At the end of the day, we're hoping that that company can build their financials to a point where they will ultimately qualify for traditional financing. So I mean, this is an interim strategy to help these companies out who have the assets to be able to collateralize the loan. But at the end of the day, where they should be, ultimately, is in traditional financing. So it is a transitional type of strategy. One that's very, very helpful, because We've dealt with companies where their financial statements are not as strong as they should be, but they're sitting on a lot of good collateral. And we don't have to have all that collateral for these loans. We can do receivables loan, receivables and inventory, so we can do kind of hybrid strategies as well. They don't have to have all 4 types of collateral to qualify. I know this so well, I'm going to go through the next bullet right here. We typically like to do facilities of $1 to $5 million. Some of your larger banks, if they do asset-based lending, are probably looking $5, $7 million as a minimum. But there's a lot of companies that can qualify by virtue of their assets, and they need something maybe more than just receivables financing. Some of these banks don't want to do a $1 or $2 million line. So that's a very, very underserved market, and that's kind of our target, if you will, to offer those size lines. We can certainly go above that, but really the bulk of the transactions that we see are $5 million and below. So it's there's quite a bit of need in that category. Not a whole lot of folks that really service it in that size of transaction.
I can tell you in the Pittsburgh market, you can't get one of the bigger banks to do an ABL loan less than 5 in most cases. In some cases, maybe 3. But there's nobody in that $1 to $2 million range for true ABL.
Another area that we're going to get into is called purchase order financing. In this particular situation, John talked about our purchase finance program. That's typically where the client brings in components, supplies, raw materials, and finishes a product which is shipped directly to their customer. In traditional purchase order financing, we're talking to a client that is a distributor, a middleman, if you will. They get an order from a customer. They have to pay a supplier, either domestic or foreign, okay? And ultimately, when that product is produced, it's shipped from that manufacturer directly to the customer. So the client doesn't touch the product, they don't do anything to it. It's a direct ship type of situation. The classic scenario that you see with purchase order financing, and this is very, very event-driven. This is in a high growth scenario. So I had a client a number of years ago that was selling small electronics. He came across a very unique type of animated toy that he was going to put out in the marketplace. He was marketing it to a number of large retailers. His biggest order prior to that time was maybe $50,000. Okay? Walgreens gave him a $3 million order. Great news, it's a $3 million order. Oh, by the way, I have to pay my Chinese supplier 50% down and 50% when he leaves the dock. Uh-oh, I don't have the funds. Okay? And these typically are transactions that are very, very kind of like almost watershed transactions. It's a huge turning point for that business. So this client now, who's dealing with small retailers, now has got this huge order from Walmart or Walgreens. We did a subsequent order with CVS, but he didn't have the funds. Because of the nature of purchase order financing, it's not easily financeable in traditional banking terms. Because there's contingencies, especially like inventory coming over from China. That's not always well favored. But it's a big deal for this company, a huge deal. So in purchase order financing, we confirm the order with the customer that it's a good order. We then talk to the supplier, foreign or domestic, and negotiate the terms of payment. If it's foreign supplier, we pay by way of letter of credit. Or if it's domestic, we'll pay what's called payment against documents, when we take receipt of goods or a wire transfer. We can finance up to 100% of the cost of the goods, so the client doesn't come out of pocket to be able to pay the supplier. And then, I'm probably getting my head of myself again here. Okay, foreign or domestic. I know this in my sleep here, okay? It's transactional in nature. What I mean by that is it could be one order and we're done, okay? I'll talk about a case study where I was working with a toy distributor, very seasonal, as you pointed out earlier. I mean, we did all of our business in about 90 days prior to getting toys into the distribution centers for Christmas. So it can be very transactional, very, very targeted. There's no long-term requirement of multiple transactions. But as I said earlier, this is typically a big, big deal. So when we deliver the goods to the ultimate customer, then we'll also finance the invoice on the other side. In some instances, I talked to a prospective client the other day. He got an order from Walmart. They wanted 120-day terms. The buyer basically had him, where he wanted him, and said, "Yeah, if you want the business in 120-day terms," because Walmart wants to sit on the funds. Very, very challenging situation. So in this, we pay the supplier, they don't come out of pocket, unless they want to put some money in the transaction. We finance the invoice on the other side, so you're not waiting 60 or 90 days, you have immediate cash flow, and you can do this on a transaction basis. Very, 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 very effective strategy for distributors, especially when they're not in a high growth phase. Okay, I'm ahead of myself. I memorized this.
Okay, so we're going to go next.
It's the right.
It comes up bullet by bullet.
Yeah, it's a transition.
Yeah.
It's a transition.
Gotcha. Okay. So now we're going to go over 4 case studies, just to give you a little bit more detail about some examples of these services we talked about. And Dave's going to mention some points from the bank's perspective and how we might work together. So the first one is a service company case study. Company's a Pennsylvania-based company working mostly in Texas and Oklahoma. It's an oil services company. It provides rig hands to the oil and gas the exploration companies. The company is a startup company, doesn't have the necessary financial history or collateral to get any kind of financing, has substantial demand for its services but little cash to fund, but it needs to pay its employees weekly, and it needs to put diesel in the trucks, and it needs to buy the safety equipment, all those things, and it doesn't get paid for 30 to 60, 90 days. Without any kind of funding, the company's just not going to go anywhere. So this is one of the, this is a flexible invoice financing situation or factoring. This company was referred to us by a former Liquid Capital client. Despite the lack of financial history, it did have a steady stream of good quality accounts receivables. So we were able to, once we got the documentation, took about 5 days to do the credit checking, get the approvals, and start funding this company. We started purchasing their accounts receivables, got them 85% of the face into their bank account within 2 days. The company started paying their employees, covering their operations, and started to grow the business. They could take on more business now. They had the funds to do it. We've been working with this company since a little over about 14 months. And I think I mentioned this earlier. I have no idea whether we'll be doing it for another 14 months or 5 years. I mean, sometimes our clients get so dependent on us because not only do we provide the financing, but we provide a lot of follow-up. So our back office will call their customers when the customer is supposed to pay on day 30 and they haven't been paying until day 37. They're going to get a call from our back office, a nice, gentle, quality control type of call to the accounts payable department. Hey, we're calling on behalf of Joe, a service company, just want to check on invoice 476 and see where it is. So we provide a lot of those ancillary services that the clients like. They get used to it, and sometimes they end up financing with us a little bit longer than even we thought they might. But it's up to them to leave and transition over to the bank whenever they want to.
And it doesn't have to be mutually exclusive from the bank. So, we all have credit limits for lines of credit based on the overall financial position of the business. But in a lot of cases, they may have a receivables base that's far in excess of what the credit limit is. We can work with a program like this and I call it spot factoring. We can agree as a bank to subordinate or carve out certain receivables so that they can be purchased and cash can be brought in when we've reached our maximum limit in terms of a credit limit on a regular line of credit.
Thanks, Dave. Okay, the next example is the purchase finance program that I mentioned earlier. We have a profitable Pennsylvania manufacturer of electrical power generation equipment. It's got substantial gross profit margin. It's drawn down on most of its current line of credit, so it is bankable. It's been bankable for many years. It just doesn't have enough money to fund further product. It's turning away business because it just can't fund the raw materials to do the work. The company needs $100,000 to purchase raw materials. And without that funding, it's just not going to be able to grow. It's financially strong, and it's strong enough that we would be able to get credit insurance on the company. So that's going to be our security in this transaction. Therefore, we don't need to get a first security interest ahead of the bank, and we can work very well with the bank, because the bank doesn't have to give up any position. So in this situation, the company was referred to us by a temporary CFO, met with Liquid Capital, and we determined that they met the initial financial criteria, which is a current ratio of not less than 0.8 to 1, positive EBITDA, and sufficient gross profit margin to cover the expenses of the transaction. We were able to get credit insurance on the company, and we arranged to purchase those $100,000 of raw materials from their vendor, which were shipped directly to the client, allowing the client to build these additional generation units, sell them, and pay us back within a period of 2 to 3 months. Again, we didn't need to take any security position ahead of the bank, and this financing enabled the client to grow the top line in a manner that they wouldn't have been able to without this financing. Fairly quick turnaround on the transaction. Once we get the documentation, it's usually a 10 to 15 day process, and works out well for the client.
In this case, I talked about the SBA contract financing. That could work in a scenario like this, but as an SBA program and a fairly high-touch SBA program, the dollar amounts where it becomes cost-effective to do that are a little higher. Whereas this program, to purchase raw materials, they can do smaller transaction size. It's really dependent on the size of the loan and the duration between how long the financing is going to be outstanding as to which of the two programs makes sense. So that's what we're going to try to do with this partnership, is sort those out on a case-by-case basis and figure out what the best program is.
Okay. So let's talk about a situation that relates to the asset-based lending. This is a Chicago-based metals tooling and stamping company, big CNC machines, these huge presses where they punch out these various types of metal products. Been around 40 years in the business, second generation. They were in a growth phase. They had just purchased some new equipment, some very specialized equipment. In fact, the one press was so large they had to reconfigure their roof because this thing was like 40 feet tall. It was a huge press. And they were getting some substantial orders, so they were growing. Now, in the process of this, they were growing, but their financials weren't that strong. I mean, they had good opportunities, but when you look at it from a financial analysis point of view, they were a little weak on traditional cash flow analysis. I was referred to this by their current bank, which is Fifth Third. I knew the lender for a number of years. He said, we like the company, we can't do any more for them. They've got substantial assets, but actually they weren't big enough for their asset-based lending. So they needed something under $5 million. Needless to say, because of the limitations of their current bank, they had concerns about their ability to continue this growth curve. They needed to have the available funds to buy the metal stock. They were adding more employees to be able to run these sophisticated CNC machines. So they were in kind of a quandary. And fortunately, we had a lender who was very sensitive to the situation. He really wanted to help them out. He knew that we offered these type of lines for asset-based lending, so he called us in. So we sat down, we looked at the situation, we analyzed their collateral, and we felt that they were a very well-qualified bank for this type of lending, even despite the fact that the financials needed to be bolstered, if you will. This is this transitional scenario that I mentioned a little bit earlier, okay? That they were going to probably leave Fifth Third, which was the case, but they needed some kind of financing to accommodate them until such time as they could find another institution, maybe get traditional lending somewhere down the road. But they were in kind of a quandary. They owned their own facility, a very large facility, so they had strong real estate, which they just had a recent appraisal on. They just had the equipment appraised because of the purchases they had recently made for these large presses. Sent somebody in there to be able to do an inventory, to value their inventory, and they had very good accounts receivable, and they were growing. So let's look at the solution. Okay. I've got this memorized, guys. Okay. I've got this memorized. So an ABL facility was established, a revolving line of credit supported by the collateral again, which was very strong. Then they had the ability now to be able to confidently grow their business, knowing that they had the funds available to be able to take these new orders, be able to increase their inventory levels, and ultimately, the result of that was because they were growing fairly rapidly, they were adding more receivables. So as that collateral expanded, if you will, especially on the receivables, we were able to increase the size of the line. Okay, so it wasn't something where it was static. We got them established, but as they were growing the business, we were able to get them more availability through the asset-based line.
Now, in a situation like this, where there's already a bank involved, did you have to take a second position, or how did you work the security position for the ADL?
We bought the bank out.
Oh, you just bought the bank out?
Yeah.
Okay, that was
Just
the
bought the bank out. Yeah, just paid them off. Because they weren't going to go any further with Fifth Third. They just weren't.
And the challenge we have in banking these high growth companies with either with conventional credit is, in a lot of cases, the receivables, the sales are increasing very significantly. The receivables are increasing very significantly, but the retained earnings haven't caught up, and the company's too highly leveraged. So the idea of an ABL, until those retained earnings and those profits catch up and the balance sheet strengthens to the point, the end game would be, and we've done this in a lot of circumstances, is we'll come in then and term out what has basically become permanent working capital that got absorbed into the growth of the company. We'll term that out if there's enough collateral for our standards conventionally or with SBA, and then we'll put a regular line, conventional line of credit in place.
So yeah, Dave really points something out here. This is a truly collaborative effort to really analyze these situations and come up with specific solutions that may be a combination of strategies or a transition, if you will, and bring them into the bank as they qualify for traditional financing. So it's which is really the exciting part of the relationship, because we're really getting into a variety of scenarios where we can really kind of dig into it and send a message to the prospect or the customer. We now have a wider array of alternatives, if you will, to satisfy some fairly unique circumstances from time to time. Okay. This is a client that I had for a number of years, Midwest-based toy distributor in business, 25, 30 years. Probably had in their catalog 500 SKUs, 500 different types of toy products. I'm going to add a little bit more to this. It's not on here, but to give you a little color. They were with a fairly significant regional bank in Chicago. And they had kind of a situation where they were under what's called a forbearance agreement. So the bank wanted to retain the relationship, but they said, you got to get your financials cleaned up, otherwise, you're going to probably have to exit the bank. The bank brought in a turnaround group who I've worked with before. They brought us in to help with the financing. And the scenario here is that they bought all their stuff from China through a number of manufacturers. Now, if you remember a few years back, this lead paint thing in China, you remember that? With the lead paint scare? That was one thing that I heard. The other thing is they said because of the lead paint scare, we're going to be smart. We're going to open our own manufacturing plant in China. Well, trust me, there's a lot of things you have to go through. It's very, very difficult to have your own plant in China. Through mismanagement, fraud, business practices, they took almost a $2 million hit. Okay? And that's where they got into this forbearance situation with the bank, and they brought us in. They were doing significant business. Costco, Joann Fabrics, we've done Barnes & Noble, we've done Cracker Barrel. So they had some very, very good customers, significant retailers. That's the good news is. But of course, the larger retailers, I want 45 days terms, I want 60-day terms, I want 70-day terms. So because they were in this forbearance situation with the bank, they wanted to get their cash flowing as fast as they possibly could to try to stabilize their finances. So when somebody calls me and says, I've got a deal from Walmart, it's not always good news. To really understand some of the underlying issues. People, going back to PO financing, people work very hard to get these large orders. But when they get them, they don't understand some of the nuances of dealing with the retailer. So I work with a lot of our principals, like John, to say you really have to understand that relation. It's not always good news, just because it's a big order. Suppliers in China, typical situation, 50% deposit up front, 50% when the goods leave the dock. Okay? They're getting orders, $500,000 orders, $1 million orders, $1.5 million orders, big orders. But they didn't have the financing, so purchase order financing was called for to be able to pay the suppliers, to be able to fulfill the purchase orders, sell to the retailers, and invoice them and get the cash flow. Okay, needless to say, because of this situation, they were looking at possibly turning away orders because they didn't have the capacity to pay the suppliers, so that's where we brought the PO financing there. This is the one where I'm talking about seasonal. They did the bulk of their business in a very short period of time, all geared towards the Christmas season. So we probably had everything in the distribution centers by October. Everything in there because they're going to get them out to their individual stores. Okay, so basically, when we do these transactions, we go to their suppliers and basically say, okay, we're going to guarantee you payment. Okay. So first of all, they needed the financing, but when we dealt with them, when we deal with a foreign supplier, we give them a letter of credit. So they know, that supplier knows if they deliver the product as ordered, we're going to trigger that letter of credit, they're paid. They don't have to rely upon our client anymore. Okay? We're going to take care of that for them. So suppliers love that idea. They really love that idea because they know that there's no question that they're going to get paid. We produced the product on time, got it in distribution centers on time. Their terms with this related quite a bit with Costco, 45 days receipt of goods. Okay, so they had to wait till the product was delivered and accepted and acknowledged by Costco, and then the clock starts running at 45 days. Trust me, I don't care what they said 45 days. You'd be lucky to get it in 45 days. Costco in particular, I'm not going to pick on them too much, Costco in particular tries to figure out every way possible to delay payment. It's crazy. With this particular situation, 60 days, 75 days, 90 days, 45 days is long gone, okay? And that would have just killed the company, waiting for the cash flow. So we were able to structure the purchase order financing. We did that with probably a dozen different retailers. We did that I worked with them for 7 years, and ultimately, guess what? They took us out with an SBA loan. and now there was an SBA loan with a lender in Chicago. But it was, this is very, very typical of a purchase order type of transaction. It had a couple of other twists to it. The company is profitable, continuing to grow, and I still stay in touch with them, but they've moved on to more traditional financing.
And this is another scenario where if the bank is willing to assist their customer in getting the working capital, a bank can carve out that transaction that's being financed, basically that receivable or any of the inventory related to that particular job for this type of financing. So it doesn't have to be mutually exclusive of a bank relationship.
No. Well, as a matter of fact, they continued on with that bank till they got their SBA loan. So we carved out that, and the bank kept the rest of the security, the inventory, and all that. So we were working right alongside of the bank, making sure we're protecting the bank's interests while being able to accommodate the client's needs.
Well, we bored you all to death. The message for tonight, though, is we want to get back to our mission as much as we can, and helping as many small businesses as possible. So this is one way to do that, because partnership and having a little bit of some niche programs in our toolbox that we can use, so that we have to say no to a lesser number of small businesses. Really appreciate you all coming. We're probably going to take a break from EBU now till after the holidays, but look forward. We have all your information. We're going to probably do our next EBU in probably late January. This one was a little unique because we focused on our referral sources and professionals and resource partners that we deal with. A lot of these EBUs are geared towards business owners themselves, but you're all welcome to attend. Have a great holiday. Thanks for coming. There's still food back there, Deb? Yes. Grab something on your way out, and thanks.
That's the idea.
I've got